Thank you very much so much for including this paper in this such a wonderful program and to be here in the morning for the first paper. This is a joint work with Peter Clarks and Edouard Matin. And we studied the hunt for dollars. So let me set the stage by remember you what we discussed yesterday, or the panelists discussed yesterday. They stressed that the bank's balance sheet are facing tighter constraint since the global financial crisis of 2008 due to several reasons, but one for sure is the post-crisis regulation that has been shrinking the balance sheet capacity of many banks, including the global FX dealers. Right? At the same time, we see that the covered interest parity has been persistently violated, right? And not only this, but was directional, so implying a premium or an higher cost if you want to borrow dollars. But now if you think about that, this is puzzling because the FX swap that you would be using for a synthetic dollar funding is off balance sheet. So the regulator treated it as a off balance sheet instrument. So by then, it doesn't count and doesn't constrain the Basel III leverage ratio, right? So the friction couldn't be coming from the FX market. So the goal of this paper is to solve this puzzle and to uncover one of the real causes of the CIP deviation and to study the effect of the global distribution of dollar liquidity. Okay? So let me refresh for you. I know you are an educated audience for FX, but let me refresh for you what is the CIP, the covered interest parity, no arbitrage condition, right? If you think about that, you have two main options to raise funding in one currency. Say currency Y is the dollar, right? You get straight to the wholesale funding market in dollars, and you borrow that. You're going to pay an interest rate, let's call it IY. The other option that you have is instead to borrow in another currency, say X, right? Convert in the spot FX market into Y and lock in a forward contract in order to reconvert back to currency Y, to currency X in due course at maturity, right? So the no arbitrage condition states that these two options should cost us the same, right? This X here in blue shouldn't be there. But if you look at the time evolution of the CIP basis, so this X over time, for instance, taking the dollar and the yen, it's puzzling because you see on average a good 30 basis point of basis. You see regular spikes at the quarter end, at the end of every quarter. And third, if you compare maturities, the shorter maturity typically spikes more than the longer one. So today, this paper will give you an explanation for these three puzzles. Okay, let me set what are the main research questions we are about. The first that what is really driving the CIP basis, this mispricing, and why does it imply a more expensive dollar? Second, we want to understand the friction behind that and how the frictions are connecting the wholesale funding market to the synthetic market, and if these frictions are priced. And finally, who is affected by this friction and this balance sheet cost? And we are going to ask if the do balance sheet constraint affect more who is actually demanding this dollar, and those are the non-U.S. institutions. Okay, so let me summarize the main results up front. First, we do find that intermediary constraints largely affect non-U.S. institutions. And why? Because they must commit costly balance sheet space to obtain this wholesale funding. So the roots of the problem is the wholesale funding, not the FX market, right? And when these constraints bind, they turn into the synthetic funding using FX swaps, but this is going to be an imperfect substitute, right? And we are going to identify that using the quarter-end laboratory. Then I'm going to provide you evidence that this CIP basis, after all, reflect a regulatory shadow cost originated from the wholesale funding. And with our data, we can even estimate, roughly, the cross-border welfare transfer, right? It's going to be that non-U.S. institution pay to the U.S. dealers, right, an extra $5 billion annually for this implied shadow cost, but doesn't stop there. The cost is passed then on the customers, the non-U.S. customers, that at the end pay an extra $10 billion as an additional hedging cost. Okay, so that's the paper in a nutshell. Yes, please.
Do you have a sense of what's the denominator there?
Denominator of
so these 5 and 10 billion relative to?
Yes, we do, of course, yes. we can discuss that later. Right?
The average cost of finance in the U.S. historically is 2%. So.
Yeah. Okay, so for the sake of time, I'm going to skip the literature, which speaks to 3 large strands of the literature. And forgive me if I can't give each paper the time that deserves. So the paper, and therefore the presentation, is organized in 3 parts. First, I'm going to map the dollar funding. Then I'm going to study the substitution. And then we're going to look at the price implication. So let's start with the mapping. To do that, you need some specific unique data, right? So, and to do that, I collaborated with CLS, which is the largest payment versus payment system in the world. And we created a bespoke data set that include FX swap trading, the outstanding position, the flows, and the prices. We manually sorted more than 4,000 banks and their customers into nationality buckets. This is important. It's not where this institution physically is sitting and trading, but it's the nationality of the balance sheet. So it means that if you look at JP Morgan in London, trading out of London, we can still classify this as a US GSIP, right? A US global is systematically important bank. Right? This is important because then you can study how regulation impact an institution, and then we combine this data at the bank level with European and American wholesale money market data. So these data at the CLS are more and more in use, and we had a very good example yesterday with Amy that I studied in asset pricing framework. And this data, the geography data that I'm using here, are also now studied by several institutions, including the BIS, the Fed Board, and right now the IMF is writing the next Global Financial Stability Report, Chapter 2, based on this data. And I'm supporting them as the external expert. So please have a look in October when we get out to the Chapter 2. This is going to be interesting analysis. Okay, so once you have this data, you carefully study that, you can construct a kind of network. This is the global network of FX swaps, right? Just to give you the sense of what you can do, the average dot size represent the average outstanding position. Green means that if they are lending dollars on average, red if they are borrowing dollars on average, right? And then the arrow shows you the flows. Right here, for instance, not surprisingly, you see the US G-SIBs are the main dollar provider, but also the other big banks are providing dollars. First, sourcing dollars from US G-SIBs, and then redistributing dollars to the customers. The main demanders of dollars are the end customers, regardless of the location. Okay, let me move to the substitution now. So to understand that, you need to stay with me a moment. I know it's boring, but let's have a look to the regulation. There are two frictions. The first friction is the differential treatment across instrument, right? If you borrow dollar within a US repurchase agreement, this is going to expand your balance sheet, and therefore it's going to tighten the Basel III leverage ratio. If you instead borrow the equivalent amount via FX swap, this is an off-balance sheet, and it's not going to contribute to the, just a tiny 1% will contribute to the Basel III leverage ratio. I will return to that. The second friction is the time. So the differential reporting regime across jurisdiction, right? So most jurisdictions report at quarter end as a snapshot. So it's the very last moment of the quarter, you need to report the balance sheet items to your regulatory authorities. Instead, other countries, including UK and US, you report the daily average over the quarter, right? So then there is no scope to window dress for them. Okay? So let me give you a stylized balance sheet to understand the differential treatment across jurisdiction. So on the left-hand side, you get a simplified balance sheet for if you borrow from the wholesale funding market with a repo, right? The amount borrowed, $100, will appear in your balance sheet asset side, and assuming you have a zero haircut margin, initial margin, the bond asset that you pledged as the collateral has to remain in your balance sheet. So of course, then the asset side will expand twice, right? And the leverage ratio is going to be penalized. If you instead decide then for the other option, the outside option, which is the FX swap, right? The $100 will appear off balance sheet as FX receivable matched by an FX payable, which, affect the balance sheet or penalize just a little bit, a tiny 1%. Right? This is the reason why there is an incentive, to deviate from this balance sheet constraint, and you are incentivized to use FX swaps. And this happens at quarter end. So let's step back and get the economic mechanism behind that. We can represent that with a simple demand and supply framework, right? Left-hand side, again, wholesale funding market, demand meets supply, and you are in equilibrium. In a no frictionless environment, what happens in the FX swap market is going to be an equilibrium as well. Demand meets supply, and no arbitrage condition means that this cost is equivalent to this cost. Now we are at quarter end, and you have this additional cost represented by C that lift the cost and reduce the quantity you want to borrow in the wholesale funding market. So the incentive is to an outward shift of the demand here for the affected banks, so the non-U.S. institution, to demand FX swaps in the FX swap market. Of course, even the U.S. react. They see the opportunity to extract a rent from this, and they would increase the supply of dollars, charging essentially the shadow cost of the wholesale funding market. right? So this is also, you can revise the CIP formula to accommodate this shadow cost in the wholesale funding on the left-hand side. You might also want to accommodate a smaller shadow cost eventually in the synthetic dollar funding. With a bit of algebra, you're going to see that after all, the CIP basis will be positive as long as the relative cost, the wholesale funding, is larger, right? Okay, so this brings me to the empirical prediction. You can lay out two main predictions. First, non-U.S. banks, subject to the quarter-end snapshot reporting, want to substitute dollar funding by reducing wholesale funding and increasing the synthetic funding via FX swap. Notice that this is in contrast what has been argued in the prior literature. So in the prior literature, they thought, well, agent would withdraw from the FX market, not enter the FX market. The second prediction, it was pricing. So this inelastic demand for FX swap would allow US banks to charge the shadow cost for the outside option, increasing the CIP basis. And this is, again, in contrast with the previous literature, because now the CIP basis is originated from the wholesale funding friction, not from the FX swap market itself. Okay, so the first piece of evidence is just looking at the aggregate volume of FX swap at the quarter end. Just the aggregate volume shows you this quantity increase, which is about 200 billion at the end of the quarter. This couldn't be a supply shrink, right? It must be some quantity increase. Second, the gray line shows you what the Eurozone big banks borrow in the wholesale US repo market. And the red line instead is what they borrow via FX swap. And you see that the quarter end, the gray line spikes down, and the red line spikes up. So they essentially suggest a substitution, a compensation between the two. Then you can look at Eurozone banks, GCIP, how much they dollar borrow at the quarter end. This is the blue dashed line there. And the red line is what they borrow in other currencies. You do the same for the US GCIP, and you see a mirror image, suggesting that, it's a dollar problem, not another currency. And second, those are the non-US institutions demanding more dollars, and who is supplying that? Those are the US GCIPs. Okay? Now, we want a more causal evidence, right? So to do that, we are going to exploit the differential reporting regimes. So left-hand side, those are Eurozone banks. It's a scatter plot where you see how they change the outstanding position in the wholesale funding market in US dollar, and in the vertical axis, how they change the outstanding position in FX swap. You see a clear negative relationship, suggesting when they cut wholesale dollar funding, they increase FX swaps. This doesn't happen in the institutions that are not subject to this reporting regime. They have no scope to do that, right? So you can construct a difference in difference analysis where you explain the borrowing volume with your difference in difference estimator, saying, yes, you are at the quarter end, and yes, you are a bank that is subject to the snapshot regime. And you find that the treated banks, those are, remember, Eurozone, Japan, Switzerland, all those are subject to the reporting regime, increase the FX swap volume by 30% compared to the control group, US and UK, and decrease the repo funding by 35%, okay? Then, of course, we can also look at the pricing, and here it's visual evidence that when Eurozone bank reduces the outstanding position in the wholesale funding dollar market, the basis increases. This happens even more strongly when they are more exposed to the funding, the wholesale funding, right? We ran also a GIV, granular instrumental variables, and we found that the inelasticity is there, and then the flows of non-U.S. institutions increases the basis, right? So on the other side, there are the U.S. banks extracting a rent. And then we can even estimate who are the winners and the losers. And in a nutshell, I mean, remember that the basis is an additional cost for your hedging, right? And therefore, U.S. G-SIBs earn $5 billion more annually in revenues. The non-U.S. G-SIBs pay an extra dollar funding, but at the end, this doesn't stop there. They pass this cost to the non-U.S. customer that at the end pay an additional $10 billion for these currency hedges. Okay, let me conclude. So first, we solved the puzzle, right? Because now we can explain why CIP deviate and react to balance sheet constraint despite the fact the FX swaps are off-balance sheet instruments. Second, wholesale money market and synthetic dollar market are tightly connected, yet substitutes, imperfect substitutes. And then when there is constrained binding, non-U.S. institutions shift to the FX swap market, paying U.S. counterparties a premium reflecting the shadow cost for wholesale dollar funding. And the cost at the end is passed to the end customer. So if a policy implication of this paper is that after all, regulation has unintentionally segmented the U.S. And the non-U.S. funding markets, rising hedging costs at the end for the real economy. Thank you very much.
Thanks, David, and thanks to the organizers for the kind invitation to present this paper. So it was a pleasure to read the paper. The paper, I find it very insightful. It provides new findings and also a novel interpretation of pre-existing findings. So I recommend everyone to read it. Angelo, unfortunately, didn't have much time to go through all his results. And I think it does deserve a good read from every one of you. So this is what the paper does. The question is, what drives CIP deviations? So a simple question. The answer, as is often the case, is complicated. They provide in their paper a demand-side mechanism to answer these questions. So the author proposed a demand-side channel in which frictions in one market, the wholesale repo market, can spill over to another market, i.e. the foreign exchange swap market. And they interpret the findings as CIP deviations as a premium that non-U.S. institutions are willing to pay to access synthetic dollar funding. What do we find? We find evidence of a substitution effect. This, I would say, is the main new findings. They find that non-U.S. banks reduce on-balance sheet repo borrowing while increasing the synthetic dollar funding at quarter ends. In terms of how big the effect is, they find that this is about $50 billion of just for Eurozone banks alone. So it's a large effect, in absolute terms at least. And the economic costs are about $5.3 billion in terms of, so the US dealers earn around $5 billion per year from this premium that they charge to clients. And they also argue that the costs are passed on to end customers who pay around $10 billion per year for hedging costs, that is to access synthetic dollar funding. I have one main comment. I have several other comments at the end. I'm not sure I will have time to go through them, but so I decided to go through the main one. My main comment is about the interpretation of the evidence in the context of a previous literature. So at the beginning I said they provide, it's an insightful paper, but they provide, exactly because they provide novel interpretation of a pre-existing findings. So their claim is that our paper reverses the diagnosis on CIP breakdowns in FX markets. Previously attributed to a reduction of bank supply, we show instead that they are caused by non-U.S. banks' dollar-driven demand. So this is a key claim of a paper. I have a confession to make. Until 2 weeks ago, 1 week ago, this paragraph wasn't there. And I liked more the previous version. This is kind of critical to my own work. But more seriously, I still find it a pleasure to read. So my comment is mainly that maybe I'm biased, but I am biased. But my interpretation is that I would give it a more nuanced view in terms of demand shocks. The powerful demand shocks that are identified in this paper interact with the constrained supply conditions that are identified in prior work. And let me be more specific. So this chart is taken by a paper by Wenxin Du and co-authors. The authors, Angelo, presented a similar chart in which they saw the CIP deviations spike at quarter ends, specifically for maturities that cross the quarter end. In this case, 1 week and 1 month deviations, because the constraints become binding at quarter ends for these instruments. And this points to causal effects of banking regulation. Now, this is another diagram that I took from another paper by Wenxin Du, but this time with Jesse Schrager in 2021. And it's a simple supply-demand diagram. And this makes basically my argument in terms of the interpretation of the findings, or actually helps interpret the existing evidence. And it's very simple. So on the left-hand panel, left-hand diagram, you had that pre-global financial crisis, we can argue that the supply of synthetic dollar funding was perfectly elastic. So the elasticity was infinity. So this is represented by the horizontal supply curve in the left-hand side panel. This implicitly implies that CIP deviations are 0. This can be simply shown in the paper with my paper with Pasquale and Tianyu Wang. We have a Mickey Mouse model to illustrate this in numerical terms with formulas. Actually, Ricardo and Salim have a much more beautiful and partial equilibrium model that has some features of this. In terms of, well, actually, the feature is that post-global financial crisis, the supply curve steepens up. So here's the first chart on the right-hand side. The supply curve steepens up, and so because its regulation makes it costly to dealers to provide dollar liquidity, i.e. The price of synthetic dollar funding, which is the CIP basis, which is the premium that you have to pay to access this funding, increases with the quantity supplied. So this is the, oops, sorry. So the previous literature that is cited, i.e. the paper by Wenxin Du, my paper, and many other papers, is mainly about the steepening of the supply curve. My point today is that this is not necessarily in contrast to the evidence reported in this new insightful paper, which focuses more on the demand side, the demand channel, which is the last diagram on the right. And so they focus on movement in the demand curve. So for example, this is from my paper with Pasquale, in which we use a unique data set with disclosed counterparty identities. And my point here is that I want to show that it's consistent with Angelo's findings. And in our paper, the counterparty identity of dealers is crucial because we exploit this heterogeneity of dealers and clients to control for confounding effects and identify the supply curve at the dealer level. This is also important. We look at the dealer level evidence as opposed to the aggregate level. We also run a difference regression. I'm not going to give you details, but the left-hand side is the volume-weighted dollar basis measured in weeks for a given currency, a given dealer, and crucially also a given counterparty. And we run this difference regression for the effect that is the dummy that identifies the affected, the dealers affected by regulation, and the post is a dummy that identifies the post treatment period. Crucially, we also use fixed effects in which we use this counterparty heterogeneity. We use counterparty time fixed effects that absorb changes in the demand conditions. And this means another way to say this is that for a given counterparty in a given time that has multiple dealer relationships, we find that this given counterparty pays a higher premium to the affected dealers relative to the non-affected dealers. So this is just to say we do control for demand changes, but it's not that we ignore them, but these are just absorbed. The point of the paper is the steepening of the supply curve. So this is our finding, and we do find indeed that post-treatment, you had that the CIP basis, which tend to be negative, is more negative for when counterparties trade with affected dealers. I do have other comments. Unfortunately, I don't have time. I'll send it to you, Angelo, and we can discuss afterwards. I'll leave you with a conclusion slide. And again, it's a very interesting paper. I forgot to say it's a novel and bespoke data set, which is great. New facts, has policy implications. What I personally think it could make it even better is that I would give them more nuanced interpretation of previous work. Thank you so much.
Yeah, so I think we totally agree with Gino in the sense that it's a demand and supply mechanism. It's not that we claim it's just the demand channel that is in place. And actually in the paper we also have the estimation of inelasticity of the supply. But what the novel contribution is to indeed bring light on the demand side, quantify that, and also to isolate the origin of the problem, of the friction, which is the whole self-funding market, right? The U.S. repo market. This is where the constraints are and ties up the balance sheet of the non-U.S. institutions. So I totally agree. In the new version, indeed, there is more nuance on that. So yeah, it's spot on. Thank you very much for the comment. Thank you. If there is anything else.
Thanks, Angelo. A couple of questions. So firstly, you have that very nice event study of the demand going up during quarter ends. I guess that's quite heterogeneous, right? You must have different spikes at different times. Does it ever go negative? So do you ever see a situation where volumes fall and prices rise, which would be a supply side story? It'd be nice to know if that's true or not. And secondly, you described the 5 billion as a rent. I think that's a little bit unclear, right? Because banks are facing a cost in providing the swap. And I mean, that's a cost, it's not a rent. Their cost is going up. So I think it's a bit of a strange thing to describe it as a rent necessarily. Maybe market power may not be, but it's not obvious ex ante.
Do you want to gather questions?
Regarding the
5 minutes, otherwise
it's up to you guys. You set the rules.
You're answering. Do you want to?
Yeah. First, thank you very much. So for the first question, it's nice to contrast quarter end and year end, right? And we do have this in the year end. The year end, actually, for GSIPs, the outstanding position, the off-balance sheet position counts. So it's another natural experiment, and we do find consistent result. In there is not such a spike, and it could be even a decline of volume. The second part I didn't get. So the problem is that actually the U.S. dealers extract a rent, right, from this, and
If that price is right, if that cost is going up, it's not a rent, right? That's what I'm trying to say.
it's a rent because the other option they have, for instance, they have dollars, naturally have dollars from depositor bases, from the central bank reserves, and so on. What they could do, they could lend these dollars in the wholesale funding market, but it's not attractive. What they would gain is very tiny compared to the FX swap basis. So the incentive is too strong. So it's hard to believe that they would do. Yes.
Okay,
So-
can I suggest we do, there's a question here, we had a question. Okay, four, there's four questions. Take all of them and answer what you like, because otherwise we're going to overrun.
So very quickly, a question on the assumption on the U.S. supplier. Are you assuming that they can that there is no segmentation? They can what you call rent is obtained by arbitrage. And the second question, going back to my, if 50 billion is the denominator, this is a huge cost. This is 10%. It's just huge.
50 billion is the shift, is not the...
So what's the denominator of that 5 billion? Because
yes. Okay.
so if you can tell us to have a sense of what that means.
I think,
Can you be quick?
yeah, very quick question. I think what would be interesting is to decompose the quarter-end basis into a demand component, a supply component, and potentially a market power component. So the 60 basis points at the end of the quarter, how much is coming from each of those? Because it's clearly not just one force driving it, but all three of them. Thank you.
Okay, thanks. There's a couple. Yeah.
Hi. So I really liked your results on quarter ends. I wondered if you had any thoughts on just the steady state CIP basis being positive, and maybe that is the part that's driven mostly by supply, and then you really have the the demand side picking up at the quarter ends.
Was there one more? Somebody?
Yeah, also very quickly, just in terms of the rent. So in a way, the European banks, they could exactly mimic what the US banks do. So in terms of think of the average over time. So I think there's a benefit, the fact that they have to only report on quarter ends. So you have to balance this off. So there's probably going a rent off outside of quarter ends. There's a rent going to the European banks. So I think you would want to try and quantify both, right?
Yeah, a lot of good points, guys. Some of them, if not most, are actually answered in the paper. So the quantification of 50 billion, it's in the paper. It's here, the graph, I didn't have time, but it's the volume US dollar increase, right? So they passed from, I think it's a 30% increase of demand, or 30, 35, I don't remember, an increase of demand. Then, yes, that's a good point, Philip, I agree, because this daily average regime of the UK and US actually put pressure systematically to them, and eventually Eurozone banks could profit from them within the quarter, right? So this is a good point, and we discussed that in the paper. And that's the 30 basis point, right? I think this is also an important point. And my sense is that the wholesale funding constraint also affect the within quarter period, right? And this could be the reason why we have a systematic, at least it's not the only reason, but one reason for this balance sheet cost that create a basis. I think that's all, right? Thank you very much for your comment.